Good morning, investors. This is Tyler from Augury Research. I wanted to kind of do a video on, what is stock for dummies. So we're going to take it kind of all the way back to the absolute basics, and then we're going to do a full wrap around into, getting in depth with investing strategies, and, some relevant information that you can kind of deploy tomorrow and become a better investor, hopefully immediately as soon as you get done watching this entire video. So first off, what is stock? And this is really, really important. You have to understand what stock is, and stock is ownership of a business, and that is becoming less understood by the overall, investing public. And, I'm all for, getting investors into the market and, giving everyone a shot at business ownership. I think the number one way to build wealth is to own businesses. You want to own businesses if your goal is to, have passive income or, achieve that, that financial freedom dream that everyone has. So you want to be owning businesses, and you want to understand the value of the businesses that you own, which is also sometimes forgotten in the market, because you have media outlets really live and active, and they push ideas and get people excited. And that's kind of the goal of media companies, is to make people emotional and get emotions out of the public. So it sometimes gets a little confusing when you're new to you're new to investing, and you put on investing shows like maybe CNBC or something like that, and it's not the greatest way to learn. The best way to learn about investing is to actually maybe start your own business, or be the guy that helps run a business. I mean, we're all working for businesses. Understanding how the cash flows throughout the business is extremely important. And that's even another thing that sometimes people forget is, they think they have a secure job, but the business that they work for is completely deteriorating. These are things that you should be thinking about maybe constantly. But if you really want to be a good investor, you need to be thinking in a business mindset. So when you buy stock, you are buying a business, and the value of that business is extremely important. We're going to get into that in a minute. But understand, it doesn't matter if it's a lemonade stand across the street or, Apple. When you buy stock, you are buying ownership of a business. So you're going to want to watch how that business performs in terms of, how much product are they selling? Are their services good? What kind of business do you own? Is it a 1-star business, or is it a 5-star business? All of these things matter in investing. So, if you're thinking like that already, you're a step ahead of the game. If you're not thinking like that, you might want to wake up and start thinking like that. Otherwise, you're not going to reach that, financial freedom dream or your financial goals long term. And like I said, I truly believe that investing, buying stock, buying ownership in business is truly the absolute best way to build wealth. I know a lot of people get into real estate, but I don't think real estate comes with added risk. Generally, you're using a lot of leverage, and valuations kind of have become stretched even in real estate markets. Don't get me wrong. There's ways to make money in real estate, but there's also ways to lose money in real estate. So you need to, have a strategy and, learn that game. It's a completely different game. But, real estate, cryptocurrency, stocks, any investment asset is it's investing, right? It's all the same game of investing. They're just different routes, different mediums that people use to build wealth. But at the end of the day, the most important thing is understanding the value of these assets that you're buying and selling. And we're going to kind of get into that now. So how do you value the asset? Well, it all matters All that matters is how much cash is going to get from that asset that you purchase, whether it be stocks, real estate, cryptos, I guess. How much cash goes through that asset and into your pocket, right? So when I measure the intrinsic value of the business, I'm estimating how much cash is going to go from this asset to my pocket, because if it doesn't get to my pocket, it doesn't really do me any good, right? And that was one of the things that Buffett taught, or was actually Ben Graham, where he would take this company and have all these things, all these numbers on the board, and he would, ask his students, okay, what is this business worth? And then at the bottom, it was like, this business will never pay a dividend, never have a buyback, basically never return any of that cash to the shareholders. And, the obvious answer is zero. So some kids go in there and they try to do all the math, but if it's never going to get back into your pocket, there's no value there for you. So you should not, purchase that. And that's, probably one of the biggest concerns in cryptocurrencies is a lot of these cryptocurrencies are never going to actually put cash into your pocket. So really what those investors are doing are playing a game of musical chairs or hot potato. And, someone's going to have to hold the hot potato, and that's not going to be fun. And part of investing is, avoiding these bad ideas. So if you avoid these bad ideas and you don't ever get stuck holding the bag or the hot potato, you're going to get wealthier than your competition that does play these games, and they do lose money that way. If you kind of look around at people that have a lot of wealth, they usually don't make too many big bad decisions, right? So it's these big bad decisions that really will throw you under the bus. If you're betting too big, that's my number one sin in investing, is overbetting. Now, I run a concentrated portfolio, but I'm very conscious that I'm never overbetting. So, and if I continue to do that and do that and do that, that's really the way to accumulate wealth, is to run a concentrated portfolio, but don't overbet and don't take, never take too much risk. So, what is the value of the business? The value of the business is the total amount of dollars that are going to go into that business, and that business is going to turn those dollars to profits and then put those profits into your pocket. That's what we're looking for. So remember, the value of the business is the total amount of profits that business is going to earn in its lifetime. Now, I always get people asking me, hey, Tyler, what do you think about this industry? What do you think about this industry? I really do not care about what industry, the cash is coming from. All I care about is that the cash is showing up. Because if it's showing up, that means that I'm making money. If it's not showing up, that means I'm not making money, and my money is not working for me, as people like to say. So it's very important that it's not so much important that I'm looking into specific industries, yada, yada, yada. It's more important that I'm making sure that my cash shows up, every quarter, every year. And that's really the basis of my investing. So like one of the things I just mentioned was risk. Every investment has risk. There is no risk-free investment, right? We learn in or maybe middle school, high school, there's no such thing as a free lunch. There's no such investment without risk. And, a lot of investors like to get into real estate, and they think that, real estate doesn't go down. It does go down. Go read about the Florida housing bubble in 1921 to 27. It was really, really something. And I just read a little bit about my town. I live in Ocean Ridge, and I was kind of reading about how it got started. And, basically Palm Beach real estate is really something. If you guys don't know, I drive by houses that are $65 million right on the water, absolutely beautiful. And this was one of the hottest real estate places back in, 1920s. And, it's happened then, and 100 years later, it's not impossible that it would happen now. We saw it happen in 2008. Bubbles do form. And if you are out of position and get trapped on the wrong side of a bubble, well, it's going to hurt. And real estate's one of those industries where it's not super liquid, right? We're seeing a lot of movement now, a lot of trading of houses now, but that liquidity will dry up as people don't have that, extra cash. So just something to keep in mind. And generally speaking, when we're talking about illiquid investments, when they're absolutely beat down and people are, exiting them because they have to liquidate, generally speaking, that's a very good opportunity for real investors to come in and deploy their cash. And if you are, well positioned in the market, you will perform a lot better than someone that's, out of position. So one of the things that I do in my investing, I like to run my portfolio cash heavy. Just in case. You never know when a phenomenal opportunity is going to show up. And when it does show up, I'm ready to take advantage of it. So that's, just something to think about. You always want to be mindful of what your cash position is at. I've ran my portfolio as high as 50% cash, but now I'm really down to, I guess, maybe 70s, 70% invested, 30% cash. And that seems like a little bit of a sweet spot because I really want to take advantage of all of these phenomenal businesses in the market. But, I also want to have cash on the sideline just in case, something like a COVID-19 happens and we do get really cheap businesses again. So, how you're positioned kind of depends on your financial situation and your age and, your ability to find good investments. But, the way I handle it is I'm looking for new investments every single day, and I want to deploy a lot of this cash because I want this income coming in. So it's kind of like a happy medium between being in good position and actually, being aggressive and reaping, rewards that these businesses are, or purchasing power that these businesses are producing. So there's a couple things that I wanted to mention. I was looking over these two books. So one of them is How to Make Money in Stocks. Pretty good book. I mean, I really discounted how good this book was. I read it really early in my career. And it's actually a great starting book if you want to learn a little bit about the stock market. Not like, it's not super basic, but it will help you learn a little bit as to some things that are important, right? Like this guy does a good job explaining, institutional ownership and how that affects stock prices, quarterly over quarter earnings, stuff like that really is important. That's what investors are looking for. So this actually teaches you some really good things to look for as an investor. I definitely do recommend this book. And then I was also reading the Warren Buffett accounting book because this book explains accounting in a way, as if you are the owner of the business. And I think that's extremely valuable. So both of these books, I highly recommend. How to Make Money in Stocks by William J. O'Neill. And then Warren Buffett Accounting by Stig Broderson and Preston Preston Pish. Both good books. And one of the things that this book talks about early is that we have, when we talk about value, we want to, figure out what's the value of this business. But then we want to, understand what is the risk that I'm taking, because every investment has risk, right? So the best way to do that is to think like a business owner. And, what I do in my investing is I'm very keen on, trying to figure out how likely is it that I get this money out of the business and into my pocket. And, the best way to gauge risk is to, here's my product, right? The Augury checklist, where you actually go in there and you're running through checkpoints. I think Charlie Munger has a famous quote where it's like, before every pilot takes off, they go through a checklist. Now, My checklist is a little bit in depth, right? You're actually going to go through this and you're going to weigh the different factors. So, okay, how strong is this company's margins, right? You're going to grade it 1 through 5. Is the company worth, does the company have better margins than its competitors? And you go in and you rate all these things, and all of these factors that you find on these checklists are what I, find very important before, to check before taking off, before making an investment. So it's a really good way to help you gauge risk. And then what this journal also does is there's two different types of risk almost, right? There's dollar risk, where it's like, how much money do you actually lose? And then there's emotional risk, where, okay, dollar risk is like, how much money does the business lose? And then emotional risk is like, oh my God, I can't handle seeing this big negative on my brokerage account, and I'm out of here and I fold my cards, right? So, there's two different types of risk, and there's different ways to manage these risks. And I don't see a lot of people talking about them, but I'll share a little bit of how I look at it and how I'm managing risk. So first off, I estimate the risk with my journal. And then second, I really manage risk thinking like a business owner, where how much am I making in terms of earnings? How much am I losing in terms of earnings? And when I do research a business, how likely is it that I get this money? And how likely is it that I'm just completely wrong, right? Because sometimes I'll go through a business and I'll say, okay, I like the product. I go through my checklist. Everything's right, and I give it, a 70, 80% confidence rating. Well, there's still a chance that I'm wrong, and I might have, misgraded something, or, made a mistake in my research, or, just been dead wrong. Sometimes we're just wrong in life, and we think something's going to happen, and it doesn't turn out that way in reality. So that's, this is real risk that we're talking about. So it's always good to be conservative, but basically what I do is, I grade the business and I say, okay, on a worst case scenario, if I'm just dead wrong, how much is this asset worth? And generally speaking, that's the liquidation value. And if you don't know about liquidation value, I highly suggest you go onto my website and read about that, because I did a pretty good job explaining how to measure the liquidation value and determine it based on the financial statements that every stock or every business on the stock market is required to report to us, the potential shareholders, right? And then emotional risk. So sometimes you have two different types of trades. You have like value plays, where you're really looking for this business to produce the cash and get that cash in your pocket. And you have growth plays, which are like, okay, I'm trying to guess a little bit as to what's going to be in the future. So like, imagine Google early in the internet. That would be a growth play, where you're saying, I'm going to pay up a little bit here because this business has a huge, area to grow. And, they're going to be making a lot more money in 2020 than they are in 2002. So how I measure risk and how I manage risk on those types of investments are different. And that kind of brings in technical analysis, right? And it's kind of funny. A lot of investors will say, well, technical analysis is, baloney, like Warren Buffett, Seth Klarman, but they're actually, it's kind of silly to think like that. This is 2020. I don't know if you guys see how much, is on the internet, all the people trading out there, they're all using this stuff. And it makes sense. You're going to tell me that looking at the volume and the price action on a stock is a not important factor. I would say that's a very important factor. And you look at that, that's technical analysis. That's, don't tell me that doesn't work. I'm pretty confident that stuff matters. Now, how much it matters is pretty important. And, a lot of the ways that people are using technical analysis is very silly. But you could get a really good idea as to what's going on with the business if you pull up a chart, look at the volume, look at the price action, pull up the SEC filings, look at what's going inside this business. You're going to have a pretty good idea as to the whole story, and you're the amount of uncertainty vastly shrinks when you compare, the fundamentals and the technicals of the business, and use that together. You can get a really good gauge as to, what is truly going on, like what is reality for the particular business. And that's, I use technical analysis on every trade. I use it to manage my positions. I use it to gauge where I'm going to be buying and selling and stuff like that. So, and I think it's very valuable because it helps you plan your bets. And that's how you really, excel as an investor, is being able to identify mispriced bets in the market. And contrary to what everyone else will tell you, the stock market is this big casino. And it's like no different from showing up to the horse track or showing up to the sports book and betting on real life events. You're betting on real life business, how much money this business takes in, and you're wagering on them. Each price, the price that you pay for an asset, is extremely important. So it's always a good idea to value your wagers. And like I said, every investment, every asset has some type of risk. It's a good idea to use the price. The price determines the price. How much are you paying for this bet? And what is the reward? What is the risk? And if you're not doing these things, you're not going to excel as an investor. You're not going to optimize your portfolio returns. The best way to optimize your portfolio returns is to, one, learn a ton about the business, measure the risk, measure the reward, place probabilities on there, and then, the more the less you diversify. So I always have people saying, hey, Tyler, how should I be diversifying my portfolio? What industry should I be in? Yada, yada, yada. It does not matter. Okay. It doesn't matter what industry is producing the cash. All that matters is that the cash is going to end up in your pocket. So, my investing is like that. I don't care about the industry. I look at the industry. It helps me measure the reward potential. It helps you, think about the risk. There's a lot more risk in a hypothetical concept company than there is in, ArcDocu Solutions that literally prints for half the nation. So, yeah, you got to look at the theme, but it doesn't matter necessarily. It's not like oh my God, I got to get my money in this industry. No, I don't have to do anything. I just got to get my money into what's going to make me the most money. So the more each factor, maybe technicals play a role, maybe fundamentals play a role. The industry might play a role, theme plays a role. Like all of these factors matter. And the more that the less you need to diversify. Diversification is, you're telling me that if you got 200 businesses in your portfolio, you're going to beat me that has 8 in there. I say, no way. There's just no way. You're not going to be able to keep up, because I'm going to be able to take the 8 best players that I find out of the, 6,000 stocks on the market or 8,000 stocks on the market. I'm going to find the 8 best. That's going to produce me the most cash, and you're going to go buy 200 randomly. You're not going to beat me. And I didn't even have to be right. And another thing that's super crucial is, the allocation aspect, where me and you can have the same exact portfolio, but depending on how much each business, comprises of that portfolio, we'll have very, very different returns. If you're equal weighted and I'm, I invested a little bit different, where, I got like 30% in my top investment, 20%, 10%, etc. We'll have very different overall returns at the end of the year, even though we might have the same exact companies inside our portfolio. So that's very, very important. And a lot of people will kind of say, when we talk about industry investing, right? Kathy Wood is an extremely good theme investor. She's probably the best theme investor of all time in terms of, being early on themes. She's got to be able to get out of these positions without, losing money. But so the holding period is really important for her. And that's timing. Investing is all about timing. People say you can't time the market, and I would say, well, that's silly. And I look at it this way. you can't time the market, but I can go on and I can say, find a business that has no cash available on the balance sheet, has current liabilities, has tons of total liabilities. Product is terrible. Let's say it's what's an industry that's gotten absolutely murdered by, innovation, right? Okay, malls have gotten crushed by Amazon, or typical retail has gotten hurt by Amazon because Amazon's grown so much. Well, there's other products out there. Cable, right? Streaming is taking over cable, and cable is now a dying industry. So there's a lot of these industries. And if I find a business in a dying industry and it's got a terrible balance sheet, and it's not that hard to say, yeah, this thing only has, 5 months left of business before it's bankrupt. Okay. And then next thing you know, in 5 months, it's bankrupt. That's timing the market, right? So it's definitely not impossible. So I think that you can think of things like Kathy Wood is proving that you can time the market, in a sense that she's been able to generate nice returns early on these, theme investments. She's basically making bets that, yes, this is going to get popular. These industries are really going to grow. She's timing it. She's timing it up, and she's good at it. Now, she's still going to, do the second half of her job, which is get out of that, turn it to cash. But, that's up to her. But yeah, that's kind of the gist. And I don't want to, go too long. But overall, that's investing wrapped up in a nutshell. So, make sure you guys get these Augury investing journals, because you're going to be able to place, somewhat accurate probabilities on your businesses that you're researching, going and using this checklist. And you should be looking at these things regardless of, whatever investment you're making. These are just really good research points where you open it up and you go, okay, is revenue growth accelerating? Right? And if you want to pair it, you could pair that with this book. This book has a system of investing. What they lack is they don't teach you anything about risk and portfolio management. So, there's some really good information in here, but the entire CanSlim system gets a bad rep. Well, because they don't have a risk management system, and it's a really, it's a timing mechanism here. It's like, Peter Lynch was a great growth investor. Well, he was investing in the greatest time for growth investing, or one of them. This system works, but it's not going to work in a depression, because none of these, you're not going to find anything that fits this criteria maybe in a bear market, right? And then the second book I recommend picking up is this one, Warren Buffett Accountant by Preston Pish and Stig Broderson. Once again, this will teach you how to think like a business owner, because you're buying assets, that are businesses. And it's extremely important to understand that, because this is all about value. This is your investing is playing poker, and it's all about value. It's like, how much value is on the table at any point in time. And, each new card that turns over is, time is going by. You're seeing new events take place. The dynamics change with every new card. And it's very, very important to constantly be actively managing your portfolio and, interpreting information that's important and, making moves based on that information. Now, don't get me wrong. I'm all about, thinking long term, and I want to hold some of my companies in my portfolio. They're beautiful. I want to keep them in my portfolio for many years to come. But I won't be a dummy and just say, just ignore them in something that's blatantly obvious that I should, be pulling my money out of, or so forth. So just a couple of things that I wanted to touch on and just talk about this morning in a quick little investing lesson to kind of get people started, right? It's like, what are stocks? Stocks are ownership in businesses, and, stock ownership, business ownership comes with risk. Every business has risk. None of these businesses will last forever. So every part of investing is interesting. And it's really important that as investors, we do our best job, managing our bankroll, managing our portfolio. And, that's one of the reasons I highly recommend this product too, is because it has a plan of action in there. It asks you to, look at your bankroll and see how much money you're betting on this, and it helps you, put together risk management plans for every investment that you're making. So once again, I really do recommend that. But overall, that's basically the gist of it. We're going to have all kinds of material coming onto the website at auguryresearch.com. If you guys are interested about buying the journal, or checking out our investing newsletter, which are actually the businesses that we're researching and putting in our own portfolios, we share them with all of our customers, and that's at auguryresearch.com. I hope you guys enjoyed this quick little morning lesson. If you did, make sure you subscribe to the channel. Make sure you like this video. And until next time, we'll see you. Happy trading.